All right, stock started off the week on a bad foot. Did not build on the rebound that we had on Friday, and pretty much reversed most if not all of what happened on Friday to the upside. So we're going to break down today's move. Interestingly enough, there are a lot of good signs that kind of show that we might be kind of done with the selling right now, and it would be a very good pullback, like a very healthy pullback, which means that we should get a healthy move afterwards to the upside if things were to end now. But there are some indications, I'm going to show you which ones, there are some indications that suggest there might be more to this decline than just your typical 5% pullback, or as we saw here lately, a less than 5% pullback. So we're going to break down what those signs are that are indicating that we might need to buckle up a little bit. Not that the market's going to go into a 30% decline in 6 weeks like COVID, or even a 20% decline in a couple of months. But that we might be kind of in, like that this might take some time. It might not necessarily drop dramatically to the point where people go nuts and the financial media is going nuts, but it might take some time to flesh out a low point and then rebound. So we actually might make our way to the 200-day moving average this time. Potentially might even actually go below the 200-day moving average, like the Russell 2000, which is one of the indications that I'm going to show you here later. So I'm going to break all that down, take a look at the sector rotation, which is also not looking very positive, and then we'll take a look at our trade idea that actually comes out of that sector rotation move. So let's go ahead and get started. Today is Monday, March the 3rd, 2025. This is the Market Outlook from MarketScholars.com. My name is David Settle. Before we get going too far, I invite you to subscribe to our YouTube channel. This icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos, and join our Market Outlook Facebook group that we've created. All right, if you're watching on our blog here, check out some of these other things on the right, including our Market Outlook live videos, where I take a look at old Market Outlook trades, see whether we should stay in them or get out of them. Come down to the bottom. We also put on today's trade already before the market closed here. Come down to the bottom, click this heart. It opens up this tab. Hit that like button there. Same thing here. Click this thumbs up icon. It opens up this tab. Hit this like button. Again, the more you do that, it helps get our content out to all of our followers on these platforms. It's the first time we've been to 40 in a long time on the Market Outlook tweets. So thank you to those who do this day in and day out. Those who don't, you can do it right now while you're watching with 1 or 2 really easy clicks. It goes a really long way for us. So thank you again. All right, let's go ahead and get started and take a look at the S&P 500 with the market forecast indicator. As you can see, we are now officially in intermediate decline according to this particular indicator, dark pink shading and a red line. That's what marks it. We are below the 2.5% mark, down over 3% below the moving average. The intermediate line's in bearish territory. So just about everything that we look at here on this chart that to tell us we're in intermediate decline is showing that. And you can see it's just barely starting too. It's the first day, we're only 3 days into dark pink shading, and the first day into a red line on the moving average. The near term line did rally, crossed above 40, crossed above the intermediate line, though it did only cross above 40. This like we talked about in Friday's video. It only crossed, like we would have wanted it to cross above multiple lines, and it didn't. And the momentum line, instead of going into the reversal zone, actually dropped. So now we're actually below the near-term line. So again, suggesting the likelihood, not inevitability, but the likelihood that the near-term line will not make it to bullish levels and will instead, or at least the reversal zone at least, and will instead probably drop back down, follow the momentum line lower. That would be the expectation there. Of course, it's the NASDAQ, the MAG 7 names that are really causing this, down 5% below the moving average now. The intermediate line is actually almost in the reversal zones in the 20th percentile. So now we're going to be in cluster, at risk of clusters. Because again, you can't get a cluster until you have all 3 lines down there. So, once the intermediate line gets down there, now at any time we can get a cluster. The near term line did not break out of bearish territory. It's still actually inside the pink levels. Your momentum line is back to being oversold. Your Dow Jones Industrial Average has actually been holding up better. Remember, this is price weighted, so it's been holding up a little bit better. It's still just barely below these bull tag lows. Its intermediate line is now in the reversal zone. We're still only 2.5% below the moving average, so it's actually still rising. That's why it's yellow and not red yet. But we have 3 days of dark pink shading, so we are in bearish territory barely. But still, again, holding up better than what we're seeing on the other indexes, especially the Russell. Remember, the Russell, I told you before, the Russell is actually in correction. This is your pullback. This is your failed bounce. And now we're breaking down the lower lows. We are actually in correction mode. When you look at it, the weekly market forecast, like we had a bull tag, and we're so far this week breaking down right now. So the intermediate line is in the lower reversal zone again. Market sentiment line is in bearish territory, hence the corrections and deep in bearish territory. Sorry, I got something in my eye there. And the near-term line's rising, but it's way in the reversal in bearish levels. So we're still nowhere near a possibility. We are at the lowest level below the moving average of the past year. So we're at 0% on the PPO over here on the left. Not in the past 5 years, though. If you look back 5 years, we are in the 52nd percentile. So we have to get rid of the COVID. So let's just go back 3 years, or let's go 4 years and get rid of the COVID move. So we are in the 22nd percentile. You can see how deep we get when we are in correction, right? Which is what, again, I think the Russell 2000, just like it was over here in end of 2021, beginning of 2022, I think we're in correction mode. Whereas the S&P is barely. In fact, if you look at the zigzag, because remember, the zigzag, we look for that 5% tag. We still don't have a 5% tag. We're only down 4.79% on the S&P 500. So still no red tag there, even though, again, the Russell 2000 got the red tag, the 10% decline, got the green tag that failed to go up to new highs, and then now is down another 9%. So again, clear correction there on the Russell, even if we're not quite there yet on the S&P 500. Of course, the Nasdaq 100 is clearly down, 7-8% this time, way more than what we saw last time. I'll go ahead and remove that drawing. Way more than what we saw last time there. All right, let's take a look at the weekly chart, the other weekly chart that we like to look at. And you can see we are clearly in a bearish candle here, bigger body than what we saw last week, but not that much bigger. The moving average is down. We're still below the moving average, but we are now moving. Remember this. We have broken that 5% mark, which measures the gap between the 50 and the 200. When you're above it, once you break back below it, you usually make your way all the way down to it. The line as close as zero as possible. In fact, over here, we actually traded below the 40-week exponential briefly. That's not necessarily a good sign. Again, you look at, the 2021, the last time we had a correction was 2021 going into 2022. And again, that's what we saw. We broke the 5% mark, and we worked our way down to zero. That was the pullback, and then there was the failed pullback bounce, and then of course your correction at that point. Let's take a look at some of the 3 green arrow chart. Obviously, we have 3 red arrows here. We have and a red line now on the S&P and the Nasdaq. We have 3 red arrows and the yellow line on the Dow, which is, like I said, been holding up better. But 3 red arrows and a red line this entire time on the Russell. So clearly a bearish trend on all of these indexes. You can see the 3-month returns are negative for the S&P and the Nasdaq 100, and 3.74% 3-month return for the Dow, and 13% decline in 3 months for the Russell 2000. The Russell's down 5% year to date. The Nasdaq 100 is down 3.6% year to date. So you can see things are not looking so hot so far for 2025. Again, typical seasonal weakness this time of year. Going into March expiration, when we set the low point, generally speaking, here in the first quarter. Again, just to kind of visualize what I've been talking about there. You can see we generally get weakness here all the way into about the February expiration mark, a little bit before that, and then we bounce from there. And so we're kind of following the trend. This is kind of the normal seasonal trends, even if it's a little bit uncomfortable for some people. Let's look at the DMI. All these other oscillators now are also confirming the bearishness. We are back below 30 on the negative, even if we're still below 20 on the positive. The ADX is rising significantly there. When you look at the RSI and the CCI, they're back to 40 on the RSI, still below the minus 100. And I told you last week, breaking below minus 100 is a sign of that we are ending the trend. So that as of right now, again, this is only Monday, so we've been below 100 before. We were below 100 right here at the open, but then we finished above a minus 100 by the close. So, but getting below minus 100 on the weekly chart typically signals that we are not only in pullback mode, but we are in correction mode. See, and the same thing with the RSI breaking below 50. It typically means that we are in correction mode here. So we are susceptible right now to this pullback being a pullback that typically starts a correction. And remember, my definition of corrections and pullbacks are vastly different. It's not so naive and basic. Remember, the financial media they are tailoring their content towards, you could say like a high school level education type audience. So they keep it very, very simple for that reason. I don't have that issue with people watching these YouTube videos. So I'm not necessarily tailoring to a high school level education type audience. So my definitions are a lot less naive than what you see on financial media. A pullback, remember, is a move between the 50-day moving average down to the 200. A correction breaks the 200-day moving average, as well as the 50-week moving average, makes its way down to the 200-week moving average. A bear market is a break of the 200-week moving average for an extended period of time. So it doesn't matter what the numbers are, right? We had a 20% decline in 2022, which according to the financial media was a bear market, but we never broke the 200-week moving average. So it was a big fall, only because we were so bullish going into it. So remember, a break below a bear market is, we get below that 200-week moving average, and we generally stay below it for a long period of time. That was not a bear market because we never got below that level. So right now, we're nowhere near that level. A bear market starts with a pullback. Correction starts with a pullback. It all starts with a pullback. And then a failed bounce that does not get up to new highs, a break to new lows like we saw in the Russell 2000. That's what makes a pullback turn into a correction. And then a break, move down to the 200-week moving average, a failed bounce up to the 30, 50-week moving averages, a failure there, and then a break back down below the 200-week where we stay below it. That's the process, right? That's the process of how we go from pullback to bear market. So as of right now, some of these indicators are suggesting it's probably going to be a little bit more than just a pullback this go around. Cross our fingers that it's not, right? Because in August, we were kind of saying the same thing, but we finished that week actually bullish. After opening so far down, we finished the week up to the upside. So that doesn't guarantee, we don't have to be in correction mode. Obviously, it's really, really important what we do the rest of the week. You have Broadcom earnings coming up that can be a significant factor, as well as the jobs report, I believe, is due out on Friday this week. All right, so, and then, of course, inflation coming out next week. But we all saw the Atlanta GDP has been negative. We can talk about that a little bit later. Let's finish looking at the rest of these oscillators here. The Ichimoku cloud now is at trend level strength. Well, almost. It's got to be below -2 and above 65. So we got that, but we're not quite below the -2 level. We are below the cloud. The cloud's still not pink, but you are clearly below the cloud. The rate of change is clearly negative. Remember, when you're below the cloud, it's okay to get below the cloud or get to the bottom of the cloud as long as you bounce right up, right? That's what pullbacks do. Corrections don't do that, right? Corrections, again, in 2021, 2022, see, we get below the cloud, we bounce right back up. We get to the cloud, we bounce right back up. We got below the cloud, and we never got back up above it. Especially by the time it turned pink, we stayed below it. That is what corrections, that's how corrections start. Because corrections, you can see, stay below the cloud for an extended period of time. Whereas pullbacks don't, right? Pullbacks come down just below the cloud, get right back up above it pretty quickly. Below the cloud, get right back above pretty quickly. You can see this was on the verge of being a correction. Again, this fell 10%. So according to the financial media, was a correction. But the reality is the pullback range, the range between the 50 and 200-day moving averages was so big that you kind of had a correction type move that was just a pullback, right? Because it was the range was so big. We were so bullish coming off those lows. We were so bullish there that it made a pullback pretty deep, even though it never got below the 200 week moving average, which is what starts, we got below the 200-day moving average in this case, so it never really started a correction. It only spent like these 2 days right here below the 200-day moving average before it bounced back up. And then we really got bullish, right? Very strong bullish trend there. So we are below the cloud. The question is whether we come right back up, right? Or, which we kind of did on Friday, so we had some hope, but then we came right back down today, and really important the rest of the week to see what we end up doing there. If you take a look at the Bollinger Bands and the Keltner channels, we are back in the lower quartile after 1 day up above the lower quartile. The bandwidth is rising. It's moved outside of the Keltner channel, so we have a green dot again, and we have clearly bearish momentum down there. And again, for some context on how deep that bearish momentum can get, especially if we are in the pullback stage of a correction. Back over here was the pullback stage of a correction. You can follow my cursor over to the right to see just how bearish the momentum can get during the pullback stage of a correction. And then all the other declines during the correction too, just how deep the momentum got compared to some of these other simply pullbacks that we've had. If I take a look here at today's intraday chart, then you see we did get a new low. So the red line's still at 100, the green line's still moving down. Remember, we can set the low point. We can feel good about a low point being set when the red line drops below 70 and the green line hits 0. So of course we're pretty far away from that. That's not going to be happening anytime soon. And the range is getting bigger, right? It's getting up to that. It's past the 5% mark. But again, for context on how big the range can get during a decline, a correction decline, this is what happened. It got over the 10% mark during a correction decline, right? Sorry, my cursor's wigging out right there. These moves were all on bullish moves. That move to 10% was on a bullish move, and this was also on a bullish move, the 10%. So you can kind of see if this is a correction, we still have a ways to go if this is indeed going to hit those marks. Let's take a look at today's range and let's go to this first. Today's range and volume. The range was relatively large. You can see the range here at almost triple, more than double the daily range there. The volume above average 74 million. So when you look at the range here, I think we're moving back up to 1.5%, way away from 1%. Volume's moving higher, so we are clearly kind of in bearish mode here. Remember, when these lines are rising, it's bearish, not bullish. And then when you look at the VIX is holding up above 20. Holding up above 20 here, trading around 23, is above the 100% mark relative to the VIX 3M. And you can see the VVIX is up above 110, which again makes us susceptible to those big volatility jumps there. If you take a look at where the volatility is relative to these averages, let's pull up the VIX on this. You can see we are clearly like trending higher, like 8 and 17 days moving higher here. We're getting up to higher levels than what we've seen in some of these other pullbacks. Again, if I were to go back to the last correction that we had, right here, the VIX eventually got up into the 30s. So we'll see if that ends up happening this go around. It hasn't. The only other time it got to the 30s was that early August time frame. Again, it started, but by the end of that week, even though it started the week so poorly, right here, by the end of the week, we were back below the 17-day moving average. So it had moved that quickly despite the jump up to the upside. So we're still not there, right? There's some signs that we're leaning in that direction, but we might still be kind of, close to finishing. If we can get this red tag, see, that's the beauty of red tags on the zigzag chart, is they're always followed by a green tag. And the ones that are closer to 5% are generally followed by green tags that are closer to 10 or more. So it's the ones that are closer to, the red tags that are closer to 10 that are the dangerous ones, because they go down so much that you can get a 5% green tag without getting new highs, and that's generally when you get the failures. So far, so good. Like, we don't even have a red tag yet on this. But again, as we saw with the Russell 2000, remember the 2022 correction started with a pullback here. Well, we had already had a drop in 2021 on the Russell during Thanksgiving. We bounced up 5%. It failed. we dropped down another 15%. So we had a big number there, a small failure, and a bigger number there to lower lows. Well, that's kind of what we're getting now, right? A big number drop, a small failure, and a big number drop during the second drop at the same time that the S&P is just starting its first pullback. So we've seen this playbook play out before. I've talked to you quite a bit over the course of 2024 that there's been a lot of signs and similarities to 2021 and the end of 2021, and we may very well be seeing them starting to play out right now as we speak. All right, now let's talk about what's driving this price action. You can see IWM has really turned south. It was already kind of an underperformer along with bond yields. Bond yields were rising during this period of time. Bonds were falling. Small caps get hit harder by rising yields. So it got hit pretty hard. But you can see bonds have been rising during the last week or so, 2 weeks, and that has not helped IWM. Instead, it's actually the real estate market's gone up, but small caps have plummeted down to the downside, along with emerging markets, and the Qs have dropped pretty sharply here in the last little bit. So if I were just to zoom into today and take a look at what we see here, again, you can see at one point in time, IWM was down more than 3%. The Qs were down 2.75% before the late little push at the end of the day today. Gold is up, bonds is up, not much, but relative to stocks is up quite a bit. And interestingly enough, the dollar is down, and that has not helped. In the past, that's been kind of a benefit to stocks, is to see the dollar rising or falling. The dollar fell quite a bit today, and that still did not benefit the market. In fact, not only did the dollar fall, yields fell quite a bit. In fact, it broke the 30-day or 200-day moving average for the first time since December when we were flirting with it. But again, we only had a little bit of room to go. The 50-day was actually still below the 200 when we flirted with it last time. 50 days well above it this time, so a much more significant drop. The MACD is a lot more bearish now. The stochastics is a lot more bearish now. So we are clearly on a decline, similar to what we saw here in the fall of 2024 going into September there. So while that was pretty bullish for equities, as we've seen so far during this little run, this has not been very bullish for equities. And then if you look at the other, those are the the three-headed monster, right? Is yields and the dollar and commodities. Okay, here's commodities. Commodities are actually breaking below support here at the 50-day moving average, or the 50-day moving average, dropping below the point of control, and right now below the value area. So again, all three are breaking below support levels, and that generally has been a bullish thing for equities, but is not bullish, right? Obviously lately, like all three are clearly dropping. The dollar had a few days of rally here, but for the most part, it's been dropping. Aside from these 3 days, and again, equities are not doing so well. In fact, if I were to go to SPX, and you can see we really started this decline back, I guess it was before expiration. So we peaked here on February 19th, so it started on the 20th. So if I were to come out here, let's go to this chart, and let's go to February the 20th, right there. And you can see bonds are up 5%, right? That should be good. The dollar has been kind of fluctuating, not really up or down. The commodities are down 5%, so bond yields are down. So this should be like a really, really bullish. And yet, at this time, both the Qs and IWM falling in conjunction with each other, nearly down 8% during this period of time. In fact, if I were to rate of change this and take a look at the rate of change, you can see, so 1, 2, 3, 4, 5, 6, 7, 8 day rate of change to see kind of how that compares to other 8-day declines that we've had in the past, especially to see how it compares to maybe correction type drops. Well, we're nearly 5%, which is again not extraordinary. You can see that first drop down here in 8 days we were down 7.5%. So it's not extraordinary. It's only 5%, nothing too major yet. The Russell 2000, however, being down almost 8% is kind of, that is, a decline that typically speaks about correction there. So, things are falling, things are moving lower. It's really the NASDAQ. But if you look at the NASDAQ 100 again, during the same 8-day time frame, This is the biggest drop we've had in a while. During this whole bullish rally, this is the biggest 8-day drop that we've had. Kind of flirting there with the August of 2024 timeframe. So clearly, things are not necessarily on the up and up. And if I take a look at the ratio chart here of the Qs relative to IWM, let's take a look at that. Right, there we go. The Qs relative to IWM. We're still well above moving averages. Now, the correlation is slightly negative. Generally, it's positive. But we're still okay. We started up strong. You can see we've had lots of days where we started up and then filled in the move to the downside. And the long-term PPO is still bullish. And we're coming off of a peak here. And we'll see ultimately how that plays out. The breadth has actually, during most of this 8-day decline, the breadth has not been bad here until here just recently. Like we've been in the 20s now. We're not below the minus 35 yet, but we're in the 20s. We're gradually working our way towards zero. So we kind of really need this to end like right now, because if we do break zero there, again, this is going back to 2021, when we do break zero and we do get bad breadth, that's what turns a normal pullback into not a normal pullback, right? So we really don't want to break below that zero level. We don't want to break minus 35. Those are all things that we want to avoid. If I take a look at other breadth signs, like the number of stocks above the 50-day, we're still not below 200, right? Which can happen even during normal pullbacks. We're actually still at 241, so the ratio of number of stocks above the 50 to 200 has broken above the average. This is not a good sign. We need that, very much need that to be temporary. The number of new lows jumped up to a big number today. In fact, let's see what it actually was here. Yeah, let's refresh that page. It's looking like it's struggling there. There we go. So we are at 206. So it was updated. We're at 206 there. And that's the highest. Now remember, 115 is the 4% mark. That's a very important mark. Because when you get above 4%, especially for a sustained period of time, then you're going to be on a decline for a sustained period of time. Likely get up there and kind of end the pullbacks that we're having and bounce right back up. So this is clearly the third time we've been above 200. The last couple of times they set low points. So we really, really would like to see this be a low point here today. And then finally, the net new highs and lows for the NAT. This takes a look at the combination here of new lows, which was 721 between the NASDAQ and the NYSE. 721 minus almost 200 there. Puts us at about 500 net new lows. Again, we've seen this before. Again, let me zoom out again so you can see the beginning of that correction and how bad things got over here. You can see we were down into the minus 800s. And that was in the end of 2021 before bouncing up and failing here and then really dropping down. So, minus 500, minus 600, like this is still okay. It's a deep pullback, but it's still okay. What we don't want to see is like getting back down below the minus 600, down to minus 800. That's when the new lows are going to stay above 4% for an extended period of time. And as you can see on this chart, when I zoom out to that pullback 4 years ago, you can see the average got up. The average actually got up there at the end of 2021. And you can see now the average is working its way up again. It got up there at the end of this decline, but that's kind of when we ended it. But remember, the skew has been telling us for a long period of time that something was afoot. Right? You can see it's actually it's still at 154, still at extremes. The skew is telling us that something was a little concerning because of how high it is. It's been below the average now, and it's been dropping to really low levels. And it's still not even down to the levels where, again, we would say, okay, we're done with this, right? We're only down to 154, which, remember, anything above 150 is extreme. And obviously, the more above 150 you are, the more extreme it is. Let's take a look at how the sectors are performing. Remember, the technology sector really is our most important sector, and that's the one that's been the most concerning. This is the weekly chart of XLK. And remember, we've been below the 17-week before, like last week, but we've always bounced back up the next week. We're only one day into this week, so potentially we could still bounce back up this week and get above there, but this is not looking good. There you can see both, we're in the RRG lines are both below 100, which means when you look at this chart here, we're working our way down into the red. Everything over here is working up to the right, including your bearish cyclical sectors, the cyclical areas that outperform when the market's bearish, as well as the safety trade sectors like utilities, real estate, staples, all moving, healthcare, all moving up to the right. Financials and energy, materials also moving up to the right, but those are the cyclical areas that do well when the market's not doing well. Right? We generally want XLY, XLC, and XLK to be the areas that are outperforming because the market tends to do better, especially now because they're the stocks in those areas, the Mag 7 stocks, and maybe even Broadcom too, if you want to include them, they're all in these areas here. So, in fact, they're all on this chart that we like to look at. There are the areas that really need to perform, and they're not performing. Apple's on the decline. There's dark pink shading and a red line all across the board here. Broadcom is now getting a cluster. AMD, you can see we do have a Netflix with a bull tag. Meta's had a bull tag and hasn't really dropped yet, but everything else, Adobe, a bull tag and hasn't really dropped yet. Apple's close to a bull tag. Everything else is in full-on decline here, and this is not the kind of pattern we want to see, because that's the most important sector in the market, right? That is, that's the sector we want to see outperform the markets, and we don't want to see it. Let's see, where's let's go to this chart here. We don't want to see it underperforming, and here's the daily chart of XLK to SPY, and look at that. This is 52-week lows right now on the ratio. This is the 52-week closing low. The PPO is negative. Let me put this number in context. We'll go back to the last correction that we had over here. We're clearly below, right? We're clearly dropping here, dropping down to low levels. XLK is underperforming, and this is not a sector, like I said, that we want to underperform, because that's how corrections work, right? This is the most important sector in the market. It's got the three biggest companies in the market, as well as Broadcom, AMD, a lot of other chip stocks, software service companies are all in there. These are the biggest companies. They're the ones that have the sector, the capitalization disparities right now within a cap-weighted index. If the cap-weighted index is going to move higher, then the biggest names in that index need to move higher. So this is clearly a breakdown. Again, we're only one day into it, but it's not looking too good for the sector that we need to hold up and lead us back up to the upside. Let's see here. Okay, yes, that brings us to our trade idea today. It's actually on NVIDIA here. Was a trade that we did, and you can see NVIDIA broke down itself, has been in a bearish decline. The hope was that earnings would kind of push it back up with these bear tags, get us going. Did not. In fact, we're getting a new low on a closing basis here. Dark pink shading and a red line. Intermediate line crossing below market sentiment again. The near-term line unable to get above the intermediate line. Things are definitely south. We're below the 10th percentile here on the chart. If I look at the weekly chart for this, we are breaking below here. Give it a second here. Let's try this again. We're breaking below the 40-week exponential moving average. You can see the PPO has been converging for a long time here, even though we've been relatively bullish. But this is a clear break today. Hopefully it's not. It's just a 1 week, but doesn't look, considering how long we've been in this convergence, it doesn't look very good. If you take a look at the 3 green arrow chart, we obviously have 3 red arrows. There's been some pretty good volume here the last few days during this decline. If you look at the 2-line version, the 40-week exponential is a proxy for the 200-day, and obviously that means we're breaking below the 200-day moving average, moving into a big gap of volume here because we moved up so much over here so fast that it left a big gap in volume down to the next below 100. MACD and stochastics clearly bearish down there. If I take a look at the RSI or some of these other oscillators here, like the RSI and the CCI, those are both at bearish levels, below 40, well below minus 100 down there. If I take a look, have we skipped the DMI? Let's take a look at that one here. We are on the DMI showing a bearish pattern as well, if it will ever show up. I don't know why the internet's really slow right now. There we go. So we are above 30 on the negative indicator, below 20 on the positive. The ADX is starting to slowly rise. If I take a look at the Ichimoku cloud, we are below the cloud. Pretty clearly negative rate of change there, about to get below this. We have close to an intermediate strength trend, so we're just developing a new trend right now. We're not even trending yet to the downside. And then, of course, your Bollinger Bands and your Keltner channel, we are below the lower band. Sorry, here we go. We are below the lower band, barely. The bandwidth is rising again, pretty high levels already. And the momentum just turned negative, and we're also below that lower Keltner channel as well. So because of that big gap in volume, I decided that I would try to do, sorry, my computer's all wigging out on me here. Let me see if I can get my cursor. There we go. Oh, try this again. There we go. So we'll go check out the trades on NVIDIA. That's what we did during the Market Outlook Live. We came out to April, sold what was a 19 delta at the time that we got into this, and bought the 100 strikes. So sold the 95 again, well into the point of control. The next layer of support after that gap in volume is down at 90. So we went to the 95. 90 gives me a little bit of wiggle room there, about a 3-to-1 reward to risk ratio. So there's our trade for today. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread. Let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join us on MarketScholars.com for free. Follow and like us on Twitter and Facebook as well. Have a great rest of your Monday night, everybody. We'll see you all tomorrow.